Hey, Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. Thank you for being here on a Beer Money Sunday. Love these little informal conversations with you where we just kind of get to relax and talk about some of the things that's happening in the markets. Thank you for being here. Let me know in the chat, where you're coming from and if you can hear me all right, if you can see me all right. Actually, this morning was the first day back in the gym in about 6 months for me. They just opened the gym down here, so I am actually going to be just drinking good old fashioned water today. Feel free to crack open whatever your favorite adult beverage is, and we're gonna get started. But so great topic today for you today. There's a question by one of our Bowtie OGs, one of the founding members of the Bowtie Nation there last week, Paul. So I wanted to get it into a live chat this weekend. What to invest if you think, depending on who you think is going to win the election, right? We're talking about election 2020 stocks, and I say it's an important topic, but only because I think it's kind of important in people's minds and important for the sentiment in the market. Okay, and I'll explain that here in a little bit. That it might not actually be quite as important as people are thinking. But anyway, we're gonna get right to that. See a lot of people in the chat from Brazil, North Carolina, did a station for a little bit in North Carolina. Great state, love being there. Canada, see everybody there. Thank you for being here. And what we're not going to do today, though, is we're not going to make any predictions on who's going to win. We're not going to talk about who's better for the nation, whether it's Democrats or Republicans or Biden or Trump or any of that bullshit, really. Okay, right? I'm here to help you make money. I'm here to help you pick the stocks that might do better depending on who you think is going to win and where they're going to take the country. Okay, so we're not going to talk about any of that other crap. Who's better, who's worse, who's whatever. Okay, just not going to do it. Talk about some of the sectors and the stocks that might win under each candidate, and that's just looking at just history, some of the policies that each candidate has come out with, and where they might go. And then, of course, we're going to get to a little bit of Q&A at the end of that. I love that part of the live stream. Really, that's what I look forward to every week is just, talking back and forth with you out there in the nation. So what else? I see Russia must be, what time is it in Russia? Like 1 o'clock in the morning? Thank you for being here. That's some real dedication. Florida, a lot of Florida people here. Hopefully pretty soon be my home state. Originally from Iowa, live here in Columbia right now, but we are moving to Florida pretty soon. So I will be seeing you soon. Okay, so just want to get started here. Highlight a few of last week's videos, and then we'll get into that election investing topic. Last week had some great videos. Wednesday, I think it was Wednesday or Monday, stocks that could double. It was Wednesday's videos. Great video and a fun one to do. Everybody wants to know what are the stocks that are going to double or triple in the next 3 or 5 years or even 10 years. And I love doing it because this is really where I come from, right? As a venture capital analyst, my job was to look at these startup companies, these very small companies, under $500 million market cap typically, and a lot of times even smaller, but to look at these and find the companies that are going to provide those 3 and those 5x and the 10x returns for my venture capital partners, for the firms and for the investors. So it was a lot of fun looking through some of these small cap and smaller stocks. And wow, what a list! We had five stocks and up an average of 9%, 9.2% actually, just since the video came out on Wednesday. But still some really strong returns waiting in those stocks. We had the outlier there was Veritone with a 22% return so far just since Wednesday. But the other ones, all positive, 4% to 8% for the other 4. Some great stocks there. Check them out because I do think they're primed to run over the next maybe not double in the next year, but over the next 3 to 5 years, 2, 3, 5 times your money. So some great stocks there. Did a penny stocks for beginners video yesterday or Friday, I guess it was. Love talking about penny stocks, kind of that same theme. But you really have to know what you're getting into, where the risks are, and how to analyze these stocks, right? Because it's high risk, high return. Okay, you're not going to be able to get that high return without the risk. So you need to be able to analyze that risk, see where it's at, and see some of these stocks that the market isn't correctly pricing those. Next week's videos, because some really neat videos coming up. We're in the third quarter earnings season this Wednesday. This week is when third quarter earnings season really starts to go with. I think Alcoa is reporting tomorrow on the 12th, and that's typically seen as kind of really the formalized or the legitimate start of earnings season is when Alcoa reports. That's tomorrow. The Wednesday's video coming out there is going to be my 5 picks for earnings surprises, right? And what we've seen is, during the pandemic, is a lot of the companies. I think it's something to the tune of maybe about a third or more of the companies in the S&P 500 have actually pulled back their outlooks. Okay, so typically during an earnings call or an earnings release, a company will give you their prior quarter's earnings, and then they'll give you an outlook and a guidance and an estimate for the next quarter. And analysts, of course, use that to model their own estimates and their own expectations. Well, what we've seen is in this uncertainty around COVID, a lot of those companies have just pulled back. Have dropped all their guidance. So we have no idea what's coming up. And I think that's going to, obviously there's going to be a lot of downside risk there. But anytime you have that risk, you have that return. So there's going to be an opportunity to, if you can find those companies that might provide those earnings surprises, and then maybe even an outlook for the fourth quarter, you can have an opportunity to make some really nice returns. So that's coming up Wednesday. We're going to talk about that. Got a fun video for you Friday. It's 3 conspiracy theories about the stock market that are actually true. Okay, a lot of these things that I saw while working in venture capital and on the market with private wealth. A lot of these things, these conspiracy theories, like how the banks control the Fed, how a very select few market traders can actually control prices and manipulate the market, and how that's actually done. So going to be a fun video highlighting that for Friday. But I want to get into it, talk about that election investing. And again, we're not talking about who's better for the nation, who's better for the economy, that kind of thing. We're not making any judgment calls on here. Basically, I just want to highlight, the stocks that could do well under either administration, and kind of let you make your own decision as far as who's going to win in November, next month, really coming up. And honestly, I don't think it matters quite as much as a lot of people are saying. Obviously the media likes to buy into the election coming up as a market mover, but that's the media's job, right? The media is there to excite you, to keep you coming back to their channel and all that. Give you something to worry about, basically, and keep you tuned in, right? That's how they sell ad dollars. Honestly, though, it might not be quite as important as you might think, whether who wins or not. Especially in this market that we've got right now, the market is dealing with COVID vaccine hopes. It's dealing with the infection rate that is again climbing. We just hit, I think, 60,000 infections on Friday, which was the highest in like 2 months. We're seeing the case by case or the caseload in certain states pop up. So the market's dealing with that. Market's dealing with a sluggish economic recovery, and we'll look at that. But really, the economic recovery has kind of stagnated since June. But it's also got that ultra accommodative Fed that is basically just pulling out all the stops and pushing as much money into this market as possible. So when you take all that together, I don't think that the who wins the election is really going to move the needle that much. The market's got all these this wall of worry that it's climbing, and I'm not sure that one way or the other who wins on November 3rd is going to matter quite as much. But I also want to show you a graph here that the stock market returns under Republicans, under Democrats as president, and some of these other scenarios to show you that especially over the whole term, probably doesn't matter as much as you might think. So what we're looking at here is a graph of the average S&P 500 total return annual performance, 1950 to 2019. And this is, okay, so the left here is under a Democratic president. The 3 bars on the right is under a Republican president. Okay. And these are the 3 scenarios. Okay. So the blue is where Congress is Democrat. Okay, so the blue on the blue side is where you've got a Democrat president, Democrat control of the Congress. Blue on the right side, light blue, is where you'd have a Republican president and then Democrat control of the Congress. Green here is going to be Republican control of Congress, right? So you've got on the left, green is Democrat president, Republican Congress. Right, Republican president and Republican Congress. And then that dark blue there is going to be split. Okay, so where you've got a Democratic president, Congress is split between, the control of the House and the Senate. And what we see actually is really interesting. One, you can see that, and these are a little skewed here. If we actually strip out some of the outliers for returns during some of the boom years, like for example, the 90s under Clinton, then if you stripped that out of the left side here, the Democratic president side, then both these bars would be basically the same. I mean, they would be very close. So there is actually no proof one way or the other that the market does better under a Republican or a Democrat president. I would actually hesitate to invest purely on politics here. And I know this whole live stream is about that, but you also want to take into account all these other narratives in the market as far as the stimulus, as far as the virus, the vaccine, the economic growth, all those things. So if you strip that out, then these are much closer than even they appear here. But what's really interesting here is that the larger bars here, especially if you strip out this, the green bar, is the better, the better returns here. If you look at this, are when it's actually split. Okay, so here where we have a Democratic president and a Republican control of Congress, then that's 18.5% annual return here over this period. When you've got a Republican president and a Democratic Congress, 10.7, so higher than the Republican president, Republican Congress here. And then of course when you've got split, that dark blue line, when you've got a split Congress and either president from either party, you've got higher returns. So really, it seems like the market is telling us, you know what? We don't care who's president. We don't care who is Congress. We just don't want them interfering in what we're doing, okay? We want them to get the hell out of the way. You have them arguing with each other, okay? That's what typically is going to happen when you've got, a Democrat president, Republican Congress, or a Republican president, Democrat Congress, or split Congress. They're just going to be bickering among each other, and not really that much is going to get done anyway. So, and that's when you have the best markets. So it might not necessarily be who wins, just that, maybe they're off doing their own little thing in DC, and the rest of us can get down to business and actually make some money. So just a little bit of evidence in that might not really mean quite as much what happens in November 3rd. But again, you also have to ask yourself, and this is true whenever you're investing, is you always have to ask yourself, what is the market pricing in right now? Okay, and that's where you really make those returns, right? Because the market is pretty much efficient. It's as close to efficient as you can get, just because there are so many millions and millions of investors, of traders in stocks all at the same time. It kind of balances out to one market narrative. Okay, where is the economy going? Who's going to win? Where their policies are going to be? What's the COVID going to look like? When we're going to get a vaccine? So it all balances into one market narrative that is really driving prices. And your job as an investor, if you're going to make that alpha return, okay, and understand there's nothing wrong with just investing in an index fund, investing in the market, and taking what the market gives you as far as a return. That's fine. But if you want that alpha return, that above market return, then your job is to figure out, okay, what's the market pricing in and where is it wrong? What is actually going to happen? Where is that market narrative wrong, and how can I profit from that? Okay, so right now, let's look at what the market is actually pricing in. And right now, honestly, the market is pricing in the possibility of a Democratic sweep of the White House and the Senate, and then controlling that, controlling the House still. Now they're saying that, okay, you know what? Democrats have historically been the ones that are pushing for more government spending. The Democrat-controlled House pushed for a $3.4 trillion coronavirus Part 2 stimulus, I guess, what you'd call it. in May. And they're still holding out for maybe 2.2, 2.4 trillion now, which is higher than the Republicans in the Senate want, right around 1.5 trillion. So what the market, the collective market, we're not talking about individual investors, we're talking about collective market is, they're looking at the polls, which, Democrat Joe Biden is ahead by anywhere from 9 to 12% on the national level, as well as in a lot of the swing states, he's ahead by 5-7%. And they're looking at that, they're looking at the Senate races, and that's the market narrative, okay? Now, you can choose not to believe the polls. You can say that there's a large wave of Trump supporters that aren't in the polls, whatever. That's like I said, again, I'm just going to tell you what the market is looking at, that market narrative, the stocks that might win under each, and then you make your own assumptions as far as who's going to win and which stocks to invest in. But right now, the market is looking at, okay, you know what? Even if we're not getting a stimulus deal right now, if the Democrats sweep the Senate and the White House in November, then we're going to get a massive stimulus bill. And again, no judgments whether that's that kind of spending, that extra $2-3 trillion in spending is going to be good for the economy long term. But undeniably, when you push that much money into the economy, and this is what we've been seeing since March, you push trillions of dollars into the economy, that's going to boost asset prices. Okay, we've already had somewhere upwards of about $4 trillion pushed into the economy from the Fed, another about $3 trillion pushed into it by the prior stimulus bill. That's $7 trillion on an economy that's about $22 trillion. Okay, so you're looking at right around a third of the economy, a third the size of the economy pushed into it. That money, that $7 trillion pushed into the market, all at once, all in the span of about 6 months. Whether it's getting to the people that need it, whether it's actually boosting the economy that much, it's not ours to say. As investors, we need to say, okay, you know what? Any more money gets pushed into the economy, it's going to push asset prices up even further. So that's really what the market is looking at. Now, as your job as an investor, again, is to take that and say, okay, you know what? Do I think Trump is actually going to win? Do I think, maybe we're not going to get that kind of a stimulus bill? Do I think, we're going to get a vaccine maybe sooner or later? That kind of thing. And taking that and, seeing where the market is mispriced, right? So obviously, if you think, we're not going to get that level of stimulus here in, November, December, January, whatever, then the market is obviously going to be disappointed and it's going to be primed for maybe lower prices. So that's something that you would want to look at. So again, just looking at those narratives. Now I want to talk about just real quickly, kind of the stock level. Okay, the down to the stocks and the sectors that you might want to look at if you're thinking, okay, this is a Trump win or it's a Biden win. Again, we're not going to say one way or the other who's going to win, but just your own narrative or your own predictions, your own forecast. So, under a Republican win, under a Trump win in November, then you would usually have the usual Republican picks, right? Defense, energy names. Okay, those are typically the sectors that tend to do better under a Republican president, Republican Congress. Higher defense spending, less regulation on the energy sector. Another graphic I want to show you, and this is really interesting. This is analysis by Bank of America. It was in the Wall Street Journal last week, I think it was. And obviously, one of the big narratives is going to be the tax cuts. The tax cuts that were passed in 2017, their effect on corporate earnings, and what happens if those stay in place under a Trump, administration, a Trump second term, or if they're rolled back a little bit under a Biden second term. Okay, and understand, a lot of the narrative around is, Biden's going to raise taxes for everyone and kill the economy and that kind of thing. And I don't think it's necessarily true. Okay, Biden has said he wants to increase the corporate tax rate from 21%, where it was lowered. I think it was lowered from about 32% to 21% under the 2017 plan. He wants to raise that to 28%, right? Now, okay, one thing, it's only a 7% increase. Okay, so he's increasing corporate taxes, or he wants to increase corporate taxes from 21% to 28%, not taking it all the way back up to where it was before the 17 tax cuts. And honestly, that's not going to happen until 2022 at the earliest. If Biden wins the presidency, you're not going to be able to get, you're not going to be able to get tax increase in through the Senate and the Congress, even if it's controlled completely by Democrats, completely by one party. You're not going to get a tax increase in 2021. The economy is still going to be recovering. There's still going to be 10 million plus people out of work, and it's not the time to start raising taxes. Okay. So, even if Biden wins and does get his tax increase on corporate taxes through, then I would be looking at maybe 2022 at the earliest on that, which would mean, since the market is forward looking, okay, we always say that the market is kind of looking out, building its own narrative to what's going to happen, 6 months or a year into the future, and that's going to affect today's stock prices. Okay, so even if Biden wins and you're looking at maybe this tax hike, this corporate tax hike weighing on the economy, then I wouldn't think that would probably affect the market even until maybe mid 2021. Okay, so if the market is looking at 2022 corporate tax rates increase maybe by 7% on average, then mid 2021 maybe that would start affecting the market. So this research by Bank of America is really interesting. This shows you on the left here is the index performance year to date. Okay, so these are the 11 sectors of the economy, right? You got communication services, consumer discretionary, IT, materials. Here's the S&P 500 on on average, the index. And now on the bottom here, and that is up higher, right? So 30% up at the top, down at negative 60% down at the bottom. So the higher up you go, the better these sectors did. Okay, so you see IT right around a 28% return over the last year to date. Consumer discretionary, about 25% return over the last year. And then down is worse. So you've got all the way down here at the bottom is energy, which is down, about 50%, which is just an amazing sell-off in one sector in 1 year. The bottom axis here is estimated earnings impact of Biden tax proposals. Okay, so what Bank of America did, they actually took this 7-point increase proposal in corporate taxes, and they looked at how it would affect each sector's corporate, sector level earnings. Okay, and so what we'll see, and as you move right on the graph here, left, excuse me, getting a little turned around today. If you move left on the graph, it's more negative. Okay, so it starts here, negative 7%. Clear over to the right on the graph, negative 7% consumer staples, right? So what this is saying, Bank of America is estimating that if those corporate tax rates go up by about 7%, from 21% to 28%, then consumer staples, on average, the stocks in that sector, are going to take about a 7% hit on their earnings, right? Not too bad, really. As you move further left here, it gets worse. Okay, so you've got energy here between maybe about 8%, financials about 8%, the S&P 500, the market index about 9%. So this is saying that if those corporate tax rates increase, the S&P 500, the market index, probably take about a 9-10% hit on its earnings. Now, what you want to pay attention to here is if Biden does win the presidency and you see these happening, these corporate tax increases, then the ones that are likely going to get hit are this communication services, consumer discretionary, information technology. Okay, and what I assume is that Bank of America, looking in here, they just looked at kind of the average tax benefit after those 2017 taxes for these companies. Okay, so information technology, consumer discretionary, and communication services. All three sectors did very well under those tax cuts in 2017, saved a lot of money, boosted corporate earnings, and if those are rolled back, obviously they're going to get hit. In the order of IT, looks like about 11%, 10.5%. Consumer discretionary about 11%, and communication services, so that's a lot of the FANG names, Facebook, Apple, Netflix, Google, Amazon, a lot of those names in that communication services sector, that's about a 12% hit. So again, what you want to do is, you build that into your narrative, if you think Biden is going to win the presidency and sweep the Senate, the Democrats sweep the Senate so they can push through these increased taxes, then those might be the sectors that you would want to watch out for. So we're looking at that now, and that's kind of so if Trump wins the presidency, then you would say, okay, maybe those three sectors would continue to reap the benefits of those lower taxes, that lower tax rate. Now, so conversely though, if you think Biden is going to win the presidency, then usual Democratic sector picks would be something like renewable energy. So you've got a lot of your solar names, a lot of your your wind names, that kind of thing, and then healthcare. Okay, but the drug makers, obviously. Democrats have been a little bit more vocal, a little bit more aggressive on drug prices, that kind of thing. So you might get something where biotech, pharmaceutical would be down. A lot of these other healthcare names would be up, right? So you've got the healthcare facilities, the services, the maybe the medical device makers, things like that. And this is just because, okay, you know what? The ACA did open up healthcare services to a lot of people, to tens of millions of people. Anytime you open up healthcare services to that many more people, you're pushing a lot of money, a lot of business into the sector. So healthcare did undeniably well under the ACA, under Obamacare, or the Affordable Care Act. Renewable energy kind of speaks for itself, kind of the opposite there of the energy pick under Republicans. So here, maybe stocks like Brookfield Renewables, that's ticker BEP, or Canopy Growth, another one. A video we had about 4 or 5 weeks ago on cannabis stocks, right? Obviously states are, even under a Republican president, under either president, I see cannabis stocks doing very well over the next year. They've already started to come up a little bit, and that's just because states are coming under immense fiscal pressure, right? States are facing down deficits, in the billions, right? And because states have to balance their budget, then they're either one, having to cut services, or two, they got to find some money real quick, and there's few other places to look for finding money than those cannabis taxes, the marijuana sales taxes, that kind of thing. So I think we're going to get a lot of legislation, a lot of legalization, and a lot of good news for the cannabis stocks and that kind of thing. So we're looking at Canopy Growth. We're looking at stocks like maybe I think Philip Morris has a big investment into a cannabis company. I know Stars, or STZ, Constellation Brands, which is a liquor company, largest alcohol distributor in the United States. They have a 37% investment in, I think it's Canopy Growth, in fact. So obviously those something like that would benefit as well as the pure play canopy, or the pure play cannabis companies as well. So be looking for that. Under Biden as well, I think you get a little bit better odds at an infrastructure deal, some kind of an infrastructure project. Obviously the Republicans and President Trump has talked up that infrastructure project for the last 4 years, but we haven't gotten anything. We still haven't gotten anything. And whether that's because the Congress has been divided and bitching and complaining the whole time, that's neither here nor there. But under a Biden presidency, we probably would have a little bit better chance at an national infrastructure bill, which would obviously benefit those infrastructure companies like Martin Marietta, that's ticker MLM, which makes a lot of the aggregates that go into roads and construction projects. Maybe also gold, REITs, real estate investment trust on an inflation trade. So what I'm looking at here is, if we do get a Biden win, if we do get a Democratic sweep of the Senate, control the House, then obviously they would have much more leeway, much more force to spend higher amounts. Again, just going off history, the Democrats have historically been the ones that want that higher government spending, that higher stimulus, fiscal stimulus. So if you're looking at that and you're thinking, well, you know what, we push more money into this economy, and what's going to happen? It's got to be higher inflation. Eventually, we are going to get higher inflation than expected, And that's going to benefit gold. It's going to benefit real estate. It's going to benefit those hard assets. Okay. So just some ideas there. Again, you have to make your own decision as far as, what's that market narrative? What is the market expecting to happen? And where is it wrong? If the market is expecting, as we said, if the market is expecting right now a Democratic sweep of the White House and the Senate for full control of Congress, and you think, no, it's not going to happen. If you think Trump is going to get a second term and, maybe Republicans are going to keep control of the Senate, then what does that mean for the market? What are the policies there, and how is that going to change the market narrative, and what stocks do you want to be invested in? Conversely, if you think maybe that narrative is upheld with a Biden win and maybe a Democratic Senate or what have you, then that's how you want to go also. All right, so let's open it up to question and answer. I see some questions in here. I'm going to scroll back up and catch some of those questions. If I didn't get your question, please just ask it again in the chat, and I'll try to catch some of those. So, what else? Wow, Uganda. There's a lot. This is awesome. It's always great seeing everybody here. From all over the world, Belgium, Switzerland, Romania. It's good stuff, man. I love seeing everybody here. Thank you for being here, taking a little bit part of your day to be here. Good question. What's your opinion about dollar soon crisis? It may happen. Okay, great question. From Edson, wants to know about the dollar. Where do I see the dollar? And frankly, it's tough because as a fundamental analyst, I've always been an analyst looking at the fundamentals, the economics behind everything. And it says that the dollar shouldn't be as strong as it is, right? But it's, the market's always going to prove you wrong. So a lot of people, Ray Dalio, I think, is probably the biggest proponent of a dollar crash, has been for a very long time. So don't think, you read in CNBC, you read some guy, saying a dollar crash is imminent. You got to understand, maybe this guy's been talking about a dollar crash for the last 10 years and it hasn't happened. He might be right eventually, but, one of the worst things you can do in the market is being early to the party. Right. Being early is just as bad as being wrong sometimes. So what do I think? Yes, the market or the dollar is overvalued. There is no reason why it should be as strong as it is right now. Pushing so much money into the economy, it's bound to deflate the value of your fiat currency. One of the biggest catalysts, though, that we haven't gotten for a lower dollar is just inflation, right? International currencies are priced on inflation and priced on interest rates. The last 5-10 years, interest rates have been so low everywhere else in the world that even low interest rates of 1%, 2% in the U.S. is a huge deal. So you've got this massive amount of money coming into the U.S. from international investors, from international funds, just trying to take advantage of that 1 or 2% rate they can get on treasuries, right? And of course, that props up the value of the dollar. Inflation, conversely, if a country has very high inflation, that's going to devalue the value of their currency. And we just haven't had that, despite record low interest rates, despite pushing $7 trillion into the economy, we just haven't had that inflation. So again, your job as an investor is to say, okay, the narrative in the economy with the narrative in the market with a very strong dollar is, that we don't get higher inflation, that, the U.S. interest rates stay higher than a lot of the rest of the world, and that the dollar keeps that reserve currency, outlook as far as for a hedge against risk. Okay. So those are basically the three narratives that keep the dollar strengthened. Right. So, if we do get inflation, that's going to be a major leg of this three-legged stool, or I guess, or you could think of it. That's going to be a major leg that's going to fall out if it happens, if you think it's going to happen. The reserve currency, I think that's probably the most likely to go away because, as China gets larger, as they get to control more of the world economy and develop those financial bonds with other countries, then people are going to be more people are gonna use the won more as a reserve currency. People might use the euro as a reserve currency. So, I think the obvious trend is to the dollar losing some of its status as a reserve currency, okay, over time now. And then the other leg was interest rates, okay. China, Asia is doing very well economically as far as the rebound. Europe is looking less well. But basically, what I'm looking at here is, the regions or the countries, the individual countries, to rebound faster from the coronavirus, they're going to be able to raise their interest rates faster. Okay, while obviously maybe the U.S. In the U.S. the Federal Reserve has said that interest rates are going to be near zero to 2022, 23, even longer. They're targeting 2% plus inflation, right? Right now it's right around 1.5%. So the Federal Reserve is telling us explicitly we're not going to get higher interest rates for years to come. So what happens is if you see interest rates coming up in other parts of the world, especially in Europe, in Asia, then that is going to be a big hit to the value of the dollar, right? Because again, why would investors want to forcing their money into U.S. Treasuries if they can get interest rates in their home countries that are just as good? So that's definitely going to be some things that I'm watching that I think could hit the value of the U.S. dollar. Now, will it be a crash? No, I don't think so. I don't think you're going to get a crash in the U.S. dollar, but it could be a long-term devaluation. So that's definitely something that you want to build into your positions, into your investments. What else do we have? Inflation. Okay. All right. Again, if I didn't see your question, just go ahead and ask it. Ask it below, and I'll try to get to it. Make sure you add a question mark there so I can see. What are the question. Is it important to watch? Do you invest in silver mining stocks like AG, First Majestic Mining Company? Actually, it's funny. Okay, so Green Dot Whisperer wants to know about silver mining stocks. First Majestic. Actually, it's funny because I've got an interview with the First Majestic CEO this week on Thursday, which means I'll probably be able to get the video up maybe Tuesday after, maybe the Thursday after, something like that. Real interesting lately. I mean, extremely interesting. We actually did a video a couple of weeks ago on the gold silver ratio. A lot of I have been investing in gold and gold miners over this last year. We did a gold mining highlight. Probably about 4 or 5 months ago. Just saw gold prices hit record highs since then. And then a few weeks ago, I did that video on the gold silver ratio, which is really interesting because it can take a lot of the risk out of that investment, right? You're not necessarily investing in whether either or is going to go higher. You're investing on the difference in those two prices, in the price of silver versus the price of gold, and you could have made some very, very nice riskless returns, not riskless, you're not dropping all your risk out of this trade, but riskless returns over the last year just by watching this gold silver ratio. Right now, I don't have any silver mining stocks. I do like the miners better than investing in the physical asset, right? Because you get those dividends, you get the leverage on the gold. We highlighted EGO probably about a year ago. That's up somewhere around 200-300% since then. We highlighted Gold Mining Core a few months ago, and that's up since then. So you get these miners that not only are they benefiting from the increase in prices, the increase in gold or silver prices, but they're also benefiting from their own leverage and their own manager strategy. So I haven't invested in silver miners yet. A lot of the gold silver ratio, the benefit to it kind of came down mid-year, but I am looking at some of those stocks. I'm looking at First Majestic. I'm looking at some of the other silver stocks. The problem is with a lot of silver miners is they're not necessarily pure plays, right? They're mining gold, they're mining copper, and silver is a little bit more of an ancillary product of some of these other mines. So it's really hard to get a pure play silver miner. So that's really what I'm looking at, what I want to talk to the CEO there of First Majestic on Thursday. Talk to him about how to invest and how to get that pure play silver investment. But great question there. REITs are literally dead, man. No, they're not. I mean, come on. And one thing, so Sasi says REITs are literally dead, and they should be for the long term. No. I mean, first of all, you got to look at REITs. Those are real estate investment trusts, companies that own real estate properties, commercial properties, and they pass on the rents down to investors. And first, you got to look at these. You can't look at these as REITs as one sector, like you do with a lot of the others. Okay, you got to look at by property type. Okay, did a video about 3 months ago on the different property types and kind of predictions and analysis for them. And yes, there are a few of those property types. And if you're in a pure play REIT, a pure play real estate investment trust in that property type, might be kind of weak. It might be a tough go. Okay, obviously malls, retail. A lot of these pure play property types, they've obviously got some long-term macro trends that are not in their favor. Okay, so the malls, the retails, obviously any kind of a retail office isn't looking great right now. Now, what you got to understand is a lot of these REITs, a lot of these stocks are bid down so far that maybe there's some upside opportunity left in them if they can rebound even from these. But longer trend office space, it's going to be tough if we have that long-term trend towards work from home and remote work, the retail and the malls as well. But you look at other property types like storage, like warehouse, industrial. Okay, if we're getting more people shopping online and get that logistics need, the delivery, obviously warehouse and logistics REITs are going to do very well. Okay, so I don't think it's not something you can say, okay, all REITs are literally dead, especially when you're talking in absolutes like that. Some of the REITs that we pointed out, obviously data center REITs, REITs that control those data center properties, the cell phone tower REITs are doing very well this year. So you just have to position for the winners and losers in that, like you would with any sector. What else? The Professionals wants to know about what states are going to decriminalize mushrooms and psychedelics. Your guess is as good as mine on that. Nick loves him some Philip Morris. I have Philip Morris as well. It's a big, not a big chunk, probably about 4% of my portfolio. What else do we have? Okay, so here's another one. Where was it? That somebody pointed out the IIRP. It's a cannabis REIT, right? So they own agricultural land, they own these warehouses or what have you behind that. So I would think that would be another good example of a REIT that should do well, especially if the cannabis market does well. Okay, what do you think the raised value stocks would you invest in Berkshire for value? Okay, so Invic wants to know what about value stocks, and yeah, I'm kind of an old school value investor at heart. So it has been tough these last 10 years where growth stocks have beaten value, but I think I think you got to look at the economics, the economy and the market background, the market environment, and you see that when we do have less than stellar economic growth, then value is generally going to outperform. So yeah, I'm looking at a lot of these value names, CVS, Philip Morris, a lot of these value names that haven't done quite as well over the last few years, just because all the money is rushed into the growth stocks, the growth names, and putting more money into that. Tien Tran wants to know what about Bitcoin. I don't invest in Bitcoin, especially not in the terms of longer term investments like I do with a lot of these stocks. Now, I will say that I have bought Bitcoin in the past, and I'll usually, I use and the name of the theory escapes me, but there's actually a theory that measures the root of the user base of any platform, and this is mind-boggling how this works, and it's very effective at analyzing any stock, any company with a with a platform that revolves around their user base. So social media stocks, Bitcoin, any company that really their ups and downs are set with that user base and growth in that user base. And the the theory says that the value of that user base is kind of the root. You can find the price with the root of that user base. I forget what it's called. I'll look that up here and put it in the comments. But generally, it's going to give you a fair market value for that company, for that stock. And what I found right now over the last year for Bitcoin is that fair value, the base value is right around 4,000, 4,500, maybe as high as 5,000. So what happens is a lot of times, when we did see more volatility in Bitcoin, quite a few times it dropped down to 5,500, 5,000, that kind of thing. Then I would buy in. I would put in 20, 30,000 into it, just a small portion of the portfolio, and then sell out when it was back upwards around 8,500. Okay, so I think I did that maybe 3 times. Obviously, missed out on the big gains. I'm not investing to 10 and 11,000. Okay. But it's just a nice, a nice trade, right? A nice trade when it drops down to that 4,500 point, somewhere around there. You put some money into it, wait for it to get back up to 8,500 and take your profits. Because frankly, 4,000, that's basically double your money. And it's much less risk than trying to say, okay, you know what, are we going back up to 20,000 Bitcoin or 30,000 or some of these other estimates and prognostications. I'm not looking at it as a long-term investment. Okay, specific picks. Okay, Vinay wants to know about long-term dividend picks. His dad just retired, wants some safe, consistent dividend stock plays for the next decade. You look in the consumer staples, you look in the utilities. What you want to do a lot of times is you start at that sector level. Okay, so which are the sectors of the economy where cash flows tend to be more stable, more secure. Okay, and obviously you've got that in the consumer staples. So the companies that sell those things that you have to buy, right? Cheerios and even soda, because people think they have to buy soda. And that's Coca-Cola for those of you in the Southeast and pop for those of you in the Northeast. Or no, what is Northeast calls it soda, Midwest calls it pop, right? Anyway, but the consumer staples, things that you got to buy, right? Bread, cheese, milk. The utilities, electricity, it's a regulated, monopolistic sector. So the cash flows are very much secure there. And then what you do, you just look within those sectors and you drill down to find the companies that are really leading in their industry. Okay, so if you want the safest of the safe, you look at GlaxoSmithKline might be okay. I would say it's quite a bit, obviously going to be quite a bit less secure, less stable, because it's in that pharmaceuticals sector, which even given its size, it's still going to be at risk to regulation and to a lot of that other stuff. If you're looking at the pharmaceuticals and the healthcare space, I would think maybe a Johnson & Johnson would be much safer dividend, just because they've got business in so many of those other consumer staples products, right? But within the consumer staples, you've got things like Coke. You've got things like in utilities, you've got utility companies that you can look at. None really come to mind offhand, but really that's where you want to start. And we've got a lot of videos on the channel. If you go to the videos tab or the videos menu, then and then search for safe dividend stocks, things like that, or long-term dividend stocks, long-term stocks, you're going to find a lot of videos for that. When are you releasing a third daily dividend video? Excellent question. We've got a series on the channel right now that is a portfolio to give you dividends every single day of the week, right? Every weekday, 5 days a week, 52 weeks out of the year, you're going to get a dividend every single day. And it's really I went through and analyzed the 466 stocks that pay dividends in the S&P 500, and then built out the strategy to where you're getting a dividend pretty much every day. You might go 0 on one day and 2 on the other, but you're getting mostly dividends every day. The next one is going to come out on November 2nd. I've got it scheduled for November 2nd. That one will come out, and there's no real rush on that one because you've got the other two. You've got the dividends on those, this one, the ones I'm highlighting, their dividends, their stocks aren't going to go ex-dividend until mid-November or into December, right? So you don't need to be buying those right now if you're just looking at picking up the dividend there and holding those long term. So November 2nd, that next one will be coming out, and you'll be able to pick those up before the next dividend. What else? Major tech correction. So Cat L, great question. Do you see a major tech correction? I mean, I've probably been more bearish than a lot of other analysts on the street over the last 4 or 5 months. It's just, if you look at and it's the economist in me, right? I worked as an economist for many years, and if you look at 8% unemployment rate, you look at tens of millions of people unemployed, the weekly unemployment numbers, so the first time filers of unemployment, are still historically high. Okay, I think something like 860,000 people filed for unemployment last week, which before this year would have been a record high. You look at that. You look at some of the data that we see by OpenTable for restaurant reservations. The dining out sector or the industry still down like 40% from a year ago, and we're getting a lot of bankruptcies in there. The economy just is not in the kind of shape that the market sees it in. Okay, and so again, you look at the narrative the market is looking at, and the narrative is we're just going to be pushing more and more money into this. Okay, we are going to push enough money into the economy from the Fed, from the government, that the economy really doesn't matter. So, if your forecast is that we get that money, then I mean, it can keep the market going well into next year. Okay, but I do think there's going to come a time where the government, the likelihood of more stimulus is going to be less, and the market is going to have to come to terms with a tech sector that is basically, I think, something like 70% premium on that long-term PE ratio, right? So, a graphic I use a lot on the channel is from FactSet Research. They show the current forward price-to-earnings ratio, so the price-to-earnings ratio of all the 11 sectors in the economy, the 10-year average of that ratio, okay, the 10-year average PE, and they kind of compare them, and if you look at those, the tech sector, stocks in the IT sector are trading at like 70% higher than what they normally are. So, my outlook is that even if we don't get a major tech crash or a correction, I'm not going to chase it. Okay. As a private investor, I don't need to chase those returns. Okay. If I was back in the day working private wealth and investing other people's money, then yeah, I have to go where the returns are. I have to beat the market to prove my worth as an analyst. But right now, as an investor, I'm not chasing that market. So I'm investing in the value sectors, right? Energy, healthcare, financials. And is that to say that we're going to get a huge bounce in these sectors? Energy is looking really rough. And it has for since 2014, really, let alone this year. So it's not to say that energy, financials, healthcare, a lot of the reasons why these are value sectors right now, it's not saying that those are going to turn around immediately. But if I'm looking out 3 to 5 years or even 10 years, then I think they're going to clean up that blood in the street, basically, right? All the fear and all the macro fundamentals in those three sectors, and I'm going to just sit back and wait for that to happen and get above market returns while that happens. I don't need to be in tech chasing those record high valuations. What else do we have? We had a super chat from here, Dave P. Said $5 super chat. Thank you, Dave. I appreciate it. Just let me know if you've got any questions there, and I'll try to answer those. Morton wants to know about the Starlink IPO. Actually, haven't followed that IPO. I will tell you that And if you've been watching the live streams over the past couple of weeks, I've talked about this. I hate the IPO market right now. I really do. It is such a shame that regular investors, Main Street investors, can't get in on IPOs like they used to. Example, when I worked as venture capital, basically the idea is to buy a company when it's 50, 100 million value, right? Build it up into 500 million, something like that, somewhere around there, and then IPO and then cash out and let Main Street investors get their own returns from that. And it was a great deal, right? Because you could buy these IPOs in the market, and this is 5, 10, 15 years ago. You could get into these IPOs in the market and still do very well as a market investor. These you couldn't get into the pre-IPOs. I mean, unless you were an accredited investor and you had a million plus net wealth, you couldn't get into those venture cap investments like my clients did. But you could still get into the IPO. And what we've seen this year, especially this year and over the last couple of years, is that's just not the case anymore. You look at IPOs like Plantier and Snowflake. They're coming to market as like $20 billion companies. And it's just ridiculous. These companies are no longer those fast growing, penny stock, growth companies that they used to be. These are huge established companies that have already gotten all the value sucked out of the venture capital and the private investors. So yeah, I would not be chasing any of the IPOs lately because it looks like even not necessarily the IPOs, but and I know Palantir went in kind of the backdoor system. They didn't do a traditional IPO. They just started trading on the market. But even that, I wouldn't be chasing any of these because they're just coming into the market as huge companies already. All the growth all the return is sucked out of them already. So I would definitely give it 6 months or so to let the prices come down if they do. A little bit more market analysis come into those companies before I would be jumping into any IPOs right now. What's your opinion on Telefonica? Is it a value buy or too much debt? Actually, honestly, I haven't looked at Telefonica for about 6 or 7 months. We actually put it into our 2020 dividend portfolio. So I did like it at that point. And I think, if you're looking for good long-term dividend stocks, it's hard to see where that one, could be too bad. It's definitely in value territory. But yeah, you're right. I mean, I would be looking at the debt. But I think as a telecom, it's still got that cash flow, that stable cash flow, that regulated cash flow. So I don't think it's any existential problems or existential risk, especially with interest rates so low. They can basically just refinance their debt whenever they need to. What else do we have? Intel Square. MLG wants to know about the SPACs, the special purpose acquisition companies, right? Like Workhorse, DPHC. This is another thing that I'm not real wild about in this market. I think it's a symptom of an overvalued market and a frenzied market. Okay, and basically what these SPACs, right, that you hear about. And basically these are companies that are IPOing on the market, getting money from investors. And the purpose is to basically provide a backdoor for companies to buy companies, a backdoor for companies to IPO into the market, right? So basically, if you IPO, if your company issues shares on the market, you have to fill out tons of forms, and it's a lot of regulatory red tape and stuff. So these SPACs, these special purpose vehicles, have found a way to kind of get a backdoor from that. They raise money as one company, and then they just buy a private company, bring it into the market, and that's their shares. And the problem with this is that a lot of them aren't very transparent. There are some of these that the company is saying, okay, you know what, we're raising money to buy this specific company, okay? And so what happens is, obviously, as an investor, you can say, okay, this company they're going to buy, how much is it worth? Is it a good investment? That kind of thing. But they're not necessarily legally restricted to that plan. And a lot of them aren't even giving you a plan. Okay. So a lot of them are saying, we're just raising money to buy some other company and to bring it into the market. Well, as an investor, as an analyst, especially, no, I'm not going to play that game. I'm not going to give you my money just on the hope that you're some great investor that's going to buy some great company and bring it to the market. And it's going to be a great investment. I want to be able to know where my money is going. And I think obviously, with the IPO market as hot as it is right now, these SPACs, they're getting tons of money flowing into them. And again, just like the IPO market, I think it's a bum deal for Main Street investors. It's not to say that some of these can't make a lot of money. They can't be great returns, but you do have to be careful because there are going to be a lot of dogs out there as well. What else we have? Safe stocks during the elections. It's a good question. I would say safe stocks. I mean, defense is probably going to be fairly safe as well, and that's because defense spending has been one of the few bipartisan issues lately. China, the rise of China, and the defense spending we need to be doing for that. So I'd say defense is probably a fairly safe investment right now. Financials might actually be a decent investment either way as well, and it's one of the sectors I'm looking at. So your banks, that kind of thing. And it's not to say that under a Democratic Congress and White House you're not going to get more financial regulation, but there's already quite a bit in there. Especially with the Fed's mandate on how much these banks can be paying out as dividends and that kind of thing. So I'm not looking at a ton more regulation coming down the pipe, even under a Democratic Congress or White House. And it's undeniably in value territory right now. Okay, so what I'm looking at in financials is if we do get more stimulus spending, especially higher spending, then that's going to be higher likelihood of more inflation. Okay, and inflation pushes interest rates up. Okay, and what we've seen, a lot of the problem these financial companies are in, especially the insurance companies, the banks, is the ultra low long-term interest rates. Okay, so basically, if you're a bank, you're paying people that short-term rate, right? And you're getting your revenue is tied to those long-term rates. Well, when the yield curve is flat, right? So when long-term rates are pretty much the same as short-term rates, then you're not making any money on those loans. Okay, you're not making that much money on a 3% 30-year mortgage minus what you're paying out in the short-term rates. So if we can get those, we already know short-term rates are going to stay where they are because the Fed has told us that they are. So if we can get those long-term rates to go up a little bit because of inflation, because of more spending, then the banks are going to start making more money, right? The insurance companies are going to start making more money, on their cash reserves. So, and I mean, under a Republican presidency and Congress, then it'd basically be, we would still get some stimulus spending, I think. So I think the rates would probably still go up as well. So I think financials is probably another one that you can look at as relatively safe no matter who wins in November. Consumer staples, obviously, always kind of a safe bet there as well. Consumer staples, utility companies, both of those are always going to be kind of your safe bets. No matter where the election goes, the economy goes, a lot of these other things. What else? Also, retailers will live. Humans are social animals. Okay, you know what? I think I'm gonna call it for this week. My voice is starting to give out, so I love being able to do this every weekend. If you've got an idea for next week's live stream, if you want to hear about a specific topic, go ahead and put that in the comments below. If I didn't get to your question, again, wait till this video is processed. It usually takes about half an hour to process. It goes up as a video on the on the channel. Go into the comments, leave your question, and I'll try to get to that. But again, I appreciate it. Thank you so much for being here this weekend. It's a great time for me, and I hope I answered some of your questions.